Hello and welcome to this model. My name is Gene, and today we are going to go through what model would I trade for life if I was to only trade one model. Now, every successful trader launches their journey to consistency, usually with a model. I also started out trading one model, and then I started to branch out to different models, and I'm at a point where I have multiple models that I utilize for execution and management. And the thing is with models, over time, you start to build experience with them. And the more insight and the more experience you gain with them, the more you start to develop other models. And usually it takes just one model for you to find breakthrough in trading. Understanding the in and out of that model can give you all the success, everything you need in trading. But now the problem is a lot of you guys want to branch out and learn multiple models and this one and that one and that one, and then you complicate it. And the problem for the most or the majority of you guys watching this video right now is that you are complicating your journey because you're trying to do everything at once. So what I'm saying is all the different things you're trying to pick up at once and learn at once, drop all of them. Focus on one. Which one resonates with you? Which one resonates with your own personality? Choose that one. Get data, get backed data. You can back test it or you can forward test the model with data and see the performance. What's the risk reward? What's the average risk reward it nets you? What is the average return it nets you weekly? What's the average return it nets you per month? What's the longest winning streak? What's the longest losing streak? You need to know the statistics of your model so you can learn to trust the model. So this is my favorite model. This is my go-to model. And if I was to only trade one model for life, what model would that be? That's this one here. The New York Optimal Trade Entry model is what we're going to be discussing today. So welcome to today's video, and we're going to delve into the New York Optimal Trade Entry model. All right, before we go into the breakdown of what the model is, let us first define what an OTE, which stands for Optimal Trade Entry. Let's define what that is. So we're gonna go from the basics, then go to the advanced or complicated. And by the end of this video, you already have an insight into what this model is all about. An Optimal Trade Entry simply is a measure of discount or premium of price. Now, in every range, we have premium, we have discount, and we have our mean threshold, which is what we call equilibrium. Price is always evaluated based off of a range. Okay, price is valued either inside a range or external to a range, and that's why you have your Fibonacci extension levels. At every given moment or at every price will either be overbought or oversold. Now we're not talking about supply and demand. We're trying to measure the value of an asset relative to its range. Now, inside a range, anything above the middle point of a range is what we call premium. Anything below the middle point of a range is what we call discount. Now let us define what premium is and what discount is. Premium is the measure of the expensiveness of an asset or a commodity. Discount is a measure of the cheapness of an asset or a commodity. If we're looking to buy, we do not want to buy when the price is expensive. Now I'm using layman terms to define premium versus discount. You don't want to go and buy the iPhone when it is worth $2,000. If you know next week is going to be worth $1,000, does it make sense for you to go and buy it now, $2,000, when you know next week is going to be worth $1,000? Of course not, because you know by next week you're already losing $1,000, or you're losing half the net worth of the iPhone. So you're gonna have to wait until it is discounted from its $2,000 price, which is expensive, to then buy your iPhone. And that's what the term, or that's where the term discount comes from. So discount essentially, if you're looking to be a buyer, you always want to buy a discount. If you're looking to be a seller, you always want to sell at premium. Now, if we are buying, we're aiming for the most premium price available to us on offer. And that's always going to come in form of the high of a range, which is the most premium price inside that range. And that's what we call a buy-sell liquidity pool. For every buy, the market will look to pair long entries with buy-sell liquidity pool because that is the most premium price inside a trading range. Same way in a sell, the market will look to pair sells at premium against sell-side liquidity pool because that is the most discount price inside the range. So this is the basic understanding of what an ultimate trade entry is. An ultimate trade entry simply is buying below discount in a bullish order flow and aiming for a buy-sell liquidity pool, which is the most premium price available to us to exit our buys, or selling above the mean of a range, aka premium, and aiming for the most discounted price offered to us or available to us on the sell side, identified as our sell side liquidity pool. And this is the basic understanding of what ultimate trade entry is. Ultimate trade entry simply is buying order flow at discount or premium and targeting counterparty liquidity pool. Sounds easy, right? And here's the key. Every successful model always finds itself thriving in its simplicity. Okay, and the problem is a lot of you guys feel you need to complicate your model for it to make money. You honestly don't. And if you backtest this model, you're gonna see the return will be literally insane. The accuracy is absolutely insane. So I don't want to do it myself. I don't want it to be a situation whereby I'm the one giving you these stats and saying, oh, this is the stats for the model. I want you, after you're done watching this video, to either go back test this over a period of a month and give me your feedback on Twitter, or you can forward test this over the next 2 or 3 weeks and then give me your feedback on Twitter and see the performance of the model itself for your trading. Now, obviously, if you're going to apply this model for your trading, you need to be free between the periods of 7 a.m. Eastern to 10 a.m. Eastern every Mondays to Thursdays, because that's the window of opportunity you're trading your model. You're not, with this model, you're not sitting in front of your charts every day. You have very specific time you show up to what I call work, okay? So when you're showing up to work, you're going to work, quote unquote, sitting in front of your charts to identify this model. If your model does not present, you're not trading. If your model presents, you're taking a trade. There's no room for emotions. There's no room for excitement when you hit take profits. There's no room for sadness when you have a losing trade. Our job is to identify our model and trade if it is present. If our risk is not elevated, which we're going to talk about on video 2. Now let's go more into the model. Let's go into the overview of what this model is. Now we already understand that our model is the New York Ultimate Trade Entry. That's what we're looking for. But let's flesh out the model and let's build up into what the model looks like with our model overview. Now, even though we're trading day trades or intra-session trades, our sentiment stems from daily order flow. Without the daily order flow, our model is useless. Our model has no value if we don't understand where the daily candle is supposed to expand up or down into. So you want to view your daily analysis just like the fuel or the gas to your car. If there is no gas in your car, you cannot drive. So the car itself is your model checklist and everything you need to do with your model. The gas, which is what allows the cat to actually function, is the daily order flow or the daily program. If you don't have an understanding of your daily program, your model is useless. Now, why is this the case? Why is this key? Because your lower time frame narrative stems from a daily order flow or a daily delivery. Everything the lower time frame does is always going to be in sync with the daily candles. If the daily is poised to expand higher, lower time frame would see bullish expansion. If the daily is supposed to expand lower time frame would see bearish expansion. If the daily is supposed to consolidate, that's where you see a lot of back and forth on the lower time frame. And by understanding the daily program and also the daily profile, you can select favorable conditions to employ your model in. Now, this is the condition we're looking for to execute our model on. Before I go into the breakdown of what you're seeing in front of me, we need to understand what conditions actually suit our model. Okay, and we're only looking to trade inside these conditions. We are waiting for when the daily candle or the daily time frame is poised to expand higher or lower into our target zone liquidity, and that's where we go in and we execute on our model. We don't want to go and trade our model if the daily time frame is in a range, or if it's range bound, or if it's showing unwillingness to want to displace. What we're looking for is we're looking for a daily program that is A, poised to displace to our target objective on the daily time frame, or B, already displacing to our target objective on the daily or weekly time frame. So usually this is the way the daily candle would expand. So you have the market expanding. If it's a bullish daily program, the market would expand from a daily discount. It could be a daily bullish auto block or a daily bullish fair value gap or breaker block. The market will start the expansion higher, and the market usually would seek a premium. Now, the same way I just taught you about discount versus premium, you don't necessarily need to aim for a swing high on the daily time frame as your terminals. You can aim for a premium range, so you can look for a bearish order block or a breaker block or a bearish fair value gap as a short-term level where the market should displace up or down into. The problem with trading is when a lot of you guys go and you approach trading, you feel like there's so many things you need to take into factor to make money. And I'm saying on this video, you don't. There's only two things the market is always doing. The market is always either seeking to reprice a level of liquidity or seeking to reprice a level of inefficiency. Everything you see on your chart, everything revolves around these two key concepts, both on the daily program or time frame, weekly time frame, monthly time frame, lower time frame. It never goes past this. So this information alone is already empowering, because you know if the market is doing something, it's either going to a level of inefficiency or it's going to a level of liquidity. Those two. So your job on the daily time frame is to identify daily conditions which are poised to expand to an higher time frame level of inefficient delivery or counterparty liquidity. That's all you're looking for. Once you validate conditions like this, you're good to go on your execution. In the process of the daily time frame expanding to our terminal, so we're going to call that premium array terminals, and that could be in form of a weekly premium, like weekly bearish order block, weekly propulsion, or weekly high, or weekly rejection block, or a daily rejection block. Okay, but it's going to be a daily or a weekly level as our terminals. In the process of the market expanding up into terminals, it will offer multiple opportunities to get in sync with the daily buy program via the 4R or 1R discount. Now, here's the key. In a daily buy program, there are only two methods of delivering price. Now, remember, I mentioned before, there's only two things the market does in terms of repricing to a level of liquidity or repricing to a level of inefficiency. The market will do so in two ways. The market would either seek counterparty liquidity via stops, or the market will seek to reaccumulate in a buy program via inefficiencies and order blocks. That's all the market is doing. Once you define the program, aka it's a buy program, around your key 4R or 1R discount array, the market will either retrace in an ultimate trade entry to a fair value gap, aka inefficiency, or the market will have a run on sell stop and then reverse in the direction of daily autoflow. And this is the only model in which the market delivers liquidity through inefficiencies or fair value gaps. And you're probably saying, like, that does not make sense. It's so simple, and that's the problem. You've been taught that for your model to actually be successful, it has to be complicated, which it really does not need to. All it needs to do is it needs to identify the baseline in terms of price delivery and get in sync with that. So again, we're looking for daily conditions that are poised to expand in the direction of our target zone liquidity, or is already expanding in the direction of our target zone liquidity, and those are the conditions that we trade in, or we don't trade at all if the market is poised to stay in a range or the market has just met an higher time frame objective. These are the two times whereby you don't trade: when the market is range bound or when the market has met a higher time frame objective and we don't know what's going to happen next. This is where we stay aside or step aside and we do nothing. But in the process of delivering to a daily terminus, a premium array, the market would do so. Trade setups will form around 4-hour time frame or 1-hour time frame discount. What you're looking for, our model is identifying 15-minute time frame executions inside this 4-hour or 1-hour discount array to get in sync with autoflow. Again, we don't necessarily need to aim for the daily terminus to take profits. All we need to do is we need to aim for a lower time frame, buys a liquidity pool, like I showed you here, and that's our model. This is the entire premise of our model, be it buys for a model or sells with a model. That's the entire premise. So we're looking for expansion in direction of daily buy program, and we're looking for bearish expansion in direction of daily sell program. The only time this model is going to fail you, or the most times the model is actually going to fail you, is when you get your daily direction buys wrong, or if you trade during conditions, which I'm going to list on video 2. There's going to be another video to this one. If you trade in those conditions, that's when you're more likely to fail. As long as your daily program is correct, you are good to go. You will find consistency with this model. You'll make tons of money with this model. Okay, so now for a daily sell program or daily bearish autoflow, in which we're aiming for a daily discount as our terminus, we look for 4-hour or 1-hour bearish fair value gaps or buy stops to sell from. So we're selling inside 15-minute time frame premium at 4-hour, 1-hour buy stops or fair value gap until the market gets to our terminus. And this is, it looks so simplistic, that's the key, right? And again, some of you guys are looking at this and you're like, oh, well, this is easy. Yeah, it was. But now the problem is going to be, how long can you stay disciplined with the model? This is where a lot of you guys actually fail, because people would get models like this and they'll go mess it up trying to tweak and add different things, right? I'm going to show you how you can go a little bit more advanced with the model. But going a little bit more advanced with the model does not necessarily equate to more profits. Okay? The guys who are making profits are the guys who are doing repetitive, simplistic things day in, day out. And this is the truth with profitable trading. Profitable trading is boring. Profitable trading is not exciting. That's where a lot of guys don't really understand. When you're trading profitably and consistently, it is a very boring phase. You're going through periods of making profits. Sometimes you're going through periods of drawdown. Sometimes you're going through winning streaks. At the end of the day, you understand that your model has statistics back in the model, and you're only trading in favor of that stat, and that's what makes you your money. You know when the odds are high for you to go in and leverage or take risk. You know when the odds are low for you to step aside and do nothing. And majority of profitable trading involves stepping aside and doing nothing. That is what profitable trading entails, or consistent trading entails. Consistent trading entails doing nothing. In the periods where you're not doing anything, that's when you preserve capital. In the periods where you're doing something, that's when you increase capital. And this is the mindset I want you to go into with this model. When you're going in and you're doing your back testing, and you're coming back to watch this video, I want you to have this mindset. Okay, for you to do this successfully, you have to get comfortable with doing nothing. Because there's going to be periods in time, especially when the daily time frame is in consolidation, there's going to be tons of periods in time where you're going to have to do nothing. You're going to have to get comfortable with doing nothing. And maybe developing a new model, which you can trade for consolidations, which I actually have one for. But again, this is not what this video is for. Okay, either you're doing that one or you do nothing, which is the best way to go about trading. You're not rushing anything, you're patient, you're waiting for the conditions to align, and then you strike, and then you step aside, and repeat the same thing day in, day out, week in, week out. And then the difference with this is, despite this being boring, eventually, over a period of time, the action compounds. And as the action compounds, you start to realize, oh, actually I have over 7 figures worth in terms of funding, and I can make more money. And that's when life starts to get exciting. But now the problem is no one is ready to play the long game. Obviously, prop firms have made it easy for you to leverage capital. There might be demo capital, but they've still made it easy for you to leverage huge sums of capital to then increase your income or gains. The problem is everyone wants to go for a max out every prop firm at once, quickly. They want to do it in the process of a week or 2 weeks or a month. Whereas in reality, it actually takes a very long time to do so. You have to consistently build and be comfortable building until you get to a point whereby all your actions have all compounded and you're starting to reap the fruit of your labor. And that is what I'm going to teach you for the next 2 or 3 videos. All right, so now let's go into our setup progression for our model. And what we're looking for is, I'm going to use a bullish trend for this example, and you can just reverse what I'm teaching for the bearish side, so I don't have to go through for both the bullish side and the bearish side, because they're essentially the same thing. They're both the same thing, or you just have to flip what I'm saying for the bearish side, and then it will make sense. So we're gonna go through our setup progression for our model before we go into the final slide, which is for the model checklist, aka what you need to go through every single time you're prepping for a model, the checklist you actually need to visit. Now, the setup progression for a model is, we need to identify that the daily program is a buy program, and we need to identify a discount, a daily discount where we're expecting the market to expand from on the daily time frame. The market will always expand from a daily discount, or the market will always start a buy program from a daily discount. What you're looking for is you're looking for that program you're trying to get in sync with to originate from a daily or high time frame discount. If it does not originate from a high time frame discount, then most likely you're nearing the end of that program, or you're going to see the market start to retrace into a discount to then continue the program or start the new program. So what you're looking for is you're looking for the daily time frame to either retrace into a discount to start the program, or the daily program or daily time frame is just recently expanding from a discount array, and then you can get in sync with that. So what you're identifying is you're identifying the daily program. In a buy program, you're looking for a daily program to be a buy or bullish, and then you transpose this to a 4-hour program. And what you're looking for is you're looking for the 4-hour program to also be a buy program. Now, here's what I mean with you transposing the daily program to a 4-hour program. If the daily is poised to expand in direction of daily autoflow and it's bullish, what you don't want to do is you don't want to go in and buy a 15-minute time frame execution because I said your time frame execution is the 5 or 15-minute discount or premium array. You don't want to go in and just buy any 5 or 15-minute discount every New York session. Not every session will see expansion in direction of autoflow. How do you select the session? Because our job with the model, let me rephrase this, and if you're taking notes, I want you to write this down on your notepad because it really is important to the model and to the success of the model. It's not just enough to identify the daily program and that the daily program is willing to see expansion to the terminals. We also need to identify that the lower time frame is in sync with the daily profile or program. So what do I mean by that? If the daily is seeing expansion higher, we want to see the 4-hour trade into a 4-hour discount and continue the expansion higher. We don't want to buy if the 4-hour time frame is retracing into a discount. If the 4-hour time frame is retracing into a discount, then the 1-hour time frame and the 15-minute time frame, they're going to be bearish. And if you try to buy, if they're bearish, you're going to lose money. And by the time the market retraces into a 4-hour discount, for the 4-hour program to resume in the direction of daily program, you've already lost equity by then. And when it's time for you to pick your trade, there's probably no ammunition left for you to pick your trade because maybe you've met your risk limit for the week or for the day, and now you're pissed off. And this is where a lot of you guys are going to struggle. You're going to struggle with the patient aspect of this model. The model involves patience. Every week, you're going to get 2 to 3 opportunities to trade in direction of the daily program or weekly autoflow. Essentially, the weekly autoflow is going to be the daily program, and your job is to wait for the 4-hour time frame to align with the daily profile. Because the 4-hour time is aligning with the daily profile, then the 1-hour program is also going to align with the 4-hour program. So here's what I mean with this. So we're going to go into a blank chart, and I'm going to describe exactly what this should look like for a trading. Okay, this part of the model, which is the setup progression, I'm going to describe how it should look like for your model. So now let's go and break this down on a daily time frame, and I'm going to do some very quick drawings here, and hopefully this makes sense. If we have let's assume that this is a daily range, okay, and I'm going to use this, and we're seeing lower prices on the daily time frame, and we have cause to believe that the daily time frame should be bullish, and we see daily time frame actually start to resume bullishness, and we see a shift in structure, or the market breaking a previous high. That is a shift in structure when we're anticipating bullishness. Then what we're looking for is we don't want to buy until the daily time frame retraces down into a daily discount, because the market has to, again, remember what I talked about with premium versus discount. We don't want to buy while the price is expensive. We want to buy when it is cheap. This goes for the daily time frame, 4-hour time frame, 1-hour time frame, and then ultimately the 15-minute time frame. So meaning, if we're looking to be a buyer in direction of daily order flow, again, the daily time frame creates the entire framework, creates our sentiment. So if our conclusion from the daily time frame is we're looking for bullishness and we have an objective drawn liquidity, then we want to make sure that if we want to be a buyer, we're not buying at a 15-minute discount that is inside a 4-hour premium. Let me show what it looks like. Now, inside this daily time frame, let's assume this leg is not actually formed, and this is a discount here. We're anticipating some kind of bullishness on the daily time frame. All right. Now, as the market retraces down into that discount on the 4-hour time frame, 1-hour time frame, you're going to see more down candles or bearishness in price as the market retraces down there. While the market is retracing lower like this. Now let's zoom in on this one here. I want us to zoom in on this retracement lower in price. Okay, so inside this daily time frame, remember this is a daily time frame. As the market is retracing down into a daily high or higher time frame discount, we're looking at a daily some form of inefficiency, right? As the market is retracing down there on a 4-hour time frame, if we zoom in closer, what you're going to see is you're going to see that the 4-hour time frame is retracing like this, or is bearish. You're going to see bearishness on the 4-hour time frame. Now, what you don't want to do here is you don't want to go in and try to buy, okay? You don't want to buy any shift in structure, because any shift in structure in the 4-hour time frame is just only going to set the stage for a lower run, because the daily has to get down here for the program to resume. Now, even though the daily program is bullish, okay, the 4-hour program is not bullish, because we're not yet at a daily discount for bullishness to ensue on the lower time frame. Now, this is what I mean when I say the daily time frame is the framework for a lower time frame understanding. Because what a lot of you guys will do in terms of using this model is you're not going to wait for the daily to get down to a level where we should see expansion higher, and then you're going to go in and look at every shift in structure on the lower time frame as a buying opportunity. Whereas in fact, it's not. Again, remember, the lower time frame is simply to get in sync with the daily program. Go and look at your lower time frame. Look at all the asset classes. Every asset classes across all time periods since the beginning of trading, this is how it's always been. The lower time frame always has to subject itself to the higher time frame price delivery. So if the daily is poised to expand higher and there is a daily discount that we should see price trade down into for a bullish expansion, we don't go in and go and try to buy any shift in structure or any for our inefficiency, bullish inefficiency. We don't try to buy there. Now you can obviously go in and say you want to sell this, but that's not what this model is teaching you. The model is teaching you to trade in sync with the daily program. So if your daily program is a buy program, you want to trade in sync with that daily program. And how do you do this? By waiting for the 4-hour program to align with the daily program and the 1-hour program to align with the daily program, and then you can go in on your 15-minute time frame and you're looking at a very specific time window to trade in one direction. You're not second guessing directions. You're not second guessing where the market should up or down into. You already know what you're looking for. Your job is to go within a certain time of the day and look for one thing. That's all you're doing. That is all you're doing. Once you've validated that the 1-hour and 4-hour program aligns with the daily program, aka if the daily is trading down or going down into a discount, what you've done here is you've identified a 4-hour discount inside that daily discount, and then you don't take any action until the daily time frame gets down there. And as soon as it gets down there, guess what? You're going to see a lower time frame shift in structure, and that's what we call institutional sponsorship. The market will always give you clues of delivery, and that's what we call institutional sponsorship. Once you get that initial pop higher, it's not going to be on the daily time frame. Again, on the daily time frame, market has to get all the way up here for it to identify a shift in structure and continue autoflow. We don't need that. We don't need daily time frame, say expansion, versus again, say autoflow. All we need to see is we need to see the market get down there into that higher time frame discount and see a willingness to want to displace on either the 4-hour time frame or the 1-hour time frame, and that's enough. Once we see that, then our job is to then go in and identify 15-minute discount arrays inside that 1-hour or 4-hour discount to buy in sync with. And once we buy from there and we start to see the market displace in the direction of autoflow, we can repeat the same process. Every single time we trade out into a 4-hour, 1-hour discount, we buy. Or every single time we run below a 4-hour or 1-hour discount, we'll look for a lower time frame, again 15-minute shift in structure, and then we buy during that time window. It is easy. All right, I think I say easy peasy Japanese or something. I watched it in a Netflix movie. I can't remember the movie. It was like easy peasy Japanese. That's what this is. All right, it is a straightforward model. It is easy. All you gotta do is you have to wait. I'm gonna do more mindset calls of this, but let's go into the program. So the daily directional bias and target liquidity sets the stage for our model. It is the backbone of our model being profitable. And once we've identified our daily program and again, it's not just enough to identify the program, but also need to know where the daily time frame is reaching for. And that is what creates what I call displacement or one-sidedness. Again, without displacement, you cannot make money. Without the market expanding, you're not going to make money. So you want to identify market conditions that are poised to expand, and that's how you make money. And they're poised to expand into a level of your objective. We seek the H4 program to align with daily buys, and we want to see the 4-hour candles retracing to a 4-hour discount for our setup anticipation, just like I talked about here. All right, so if you're looking for daily bullishness, then you don't want to go and buy when the 4-hour time frame is retracing to a daily discount. You want to wait for the 4-hour time frame and also the 1-hour time frame to retrace into that daily discount, and then you go and hunt your setup. You don't hunt your setup until the market gets into your anticipated level of expansion, or unless the market has started the expansion from that discount, then you can go and hunt your setup on the lower time frame. Your M15 setups will form inside H1 order blocks, bullish order blocks. So we're talking about buy program again. For sell programs, you just want to reverse what I'm saying, and it'll work for sell side or sell programs. All right, so for buy programs, we're looking for a 15-minute setup, which will form inside a 1-hour either bullish order block fair value gap, or sell stop. Now let me talk about this a little bit more. There are only 3 PD areas we use for a model. Again, I'm not going to specify what PD array on a model because we're using 3, and it depends again on what is present during that time window where we're hunting our setup. We're only looking for 3 premium or discount arrays, either an auto block, a fair value gap, or a breaker block. This is the only 3 PD arrays we're looking for, or we're hunting. Nothing else. We're not looking for anything else, just no new terminology, new complex thing, or any sort of thing. We're only either looking for an auto block, breaker block, or inefficiency. That's what we're looking for. And we buy from there, or we sell from there, depending on the daily program. We want to trade a model when the 1R and 4R program aligns with the daily program. Again, we don't want to trade. I'm reiterating this multiple times because it really is important to our model. We only want to execute on our model when it is in alignment with the daily program. We don't want to trade our model when the 1-hour time frame and 4-hour time frame does not align with our program, aka if the daily is retracing and we see a 1-hour time frame shift in structure on the buy side, we don't go and buy any discount on the 1-hour time frame, because we understand that any shift in structure higher only sets the stage for a run lower into that higher time frame discount. And that's how you can frame shift in structure versus runs in liquidity or runs in stops using the daily program or the daily levels. And that's how your daily levels are very key on your intraday charts. We want to trade our model when the 1-hour program, 4-hour program aligns with the daily program. And we do not need to target daily liquidity to make money. We simply need to aim for a lower time frame target in the direction of our daily buys to make consistent income. Our goal with the model is not sniper entries or Instagram entries or Twitter entries. Our goal with the model is to make money and to get wealthy and rich. If you prioritize this over looking for sniper entries and looking for entries that are good for social media, you're going to do extremely well with this model. I'm promising you this, and the reason why I'm promising you this is because I want you to go and back test this yourself. And you'll be mindfucked. You're like, I knew, a lot of you guys who are listening to this right now, you already know this model. You already knew this model. All I'm doing is I'm giving you a framework to operate with the model. You already know this model. But you're still shocked, like, this is so simple. Yes, it is. That's what a model is supposed to look like. Every model that is successful finds its success in its simplicity. That's all. Let's go into the setup progression. I believe we covered this on this slide, but we're gonna, flesh this out a little bit more on this slide here. And let's talk about the setup progression, what it looks like conceptually. All right, so what you can see here is the market starts delivery from a daily discount, and that daily discount could also be an item from discount, like a weekly discount. Sometimes, very rarely, it could be a monthly discount, but we are more focused on a daily discount because this is where majority of the framework of your setup will form. So we see a lower time frame. Again, all of this is all lower time frame expansion from a daily discount. Once we see this lower time frame expansion, we already know that we are now in a daily buy program. What we're looking for is we're looking to execute when the lower time frame program aligns with the daily program. Meaning we don't want to go and buy 15-minute time frame here or here or here or here because they are in a short-term sell program, even though the daily program is a buy program. Again, if you're trading, you want your daily program to align with your 1-hour and 4-hour program. So you don't want to be buying in a 1-hour sell program when the daily program is bullish. Same time, you don't want to be selling in a 1-hour buy program when the daily program is bearish. You want them all to align, and this is how you get in sync with your model. So if the daily program is bullish, you want your lower time frame program to align with the daily program, aka you're not buying the lower time frame when it is at premium. You're buying them where they are when they are at discount relative to their own trading range. Now, as the market retraces down into a discount, usually it's going to be a 1-hour discount or 4-hour discount what we see or what we seek is we seek a 15-minute shift in structure. Okay, so as we trade down into that 4-hour or 1-hour discount, what we're looking for displacement on the lower time frame. That's going to be a 5-minute time frame. Sorry, that's going to be a 15-minute time frame or a 1-hour time frame usually. And our goal is to buy a fair value gap on the 15-minute time frame or 5-minute time frame between 7 a.m. to 10 a.m. Eastern Standard Time. And this is what I call the standard reaccumulation protocol. So there are two protocols you're going to use for this model. Again, the model is the New York Ultimate Trade Entry model, but for the New York Ultimate Trade Entry model, there are two protocols you employ for the exact setup. You have your standard reaccumulation protocol for bullish program. If you're looking for bearish programs, you call this your standard redistribution protocol. And number two is your offset reaccumulation protocol for buy programs or offset redistribution protocol for sell programs. Now let's differentiate these two. A standard reaccumulation protocol essentially is this. The market retraces down into a fair value gap or order block inside this range and sees expansion. Usually it's going to go below the main threshold of the range or equilibrium of the range, trades into a discount. Is going to be some kind of inefficiency or bullish of the block, a discount, then the market sees expansion. This is your standard reaccumulation protocol. Now for our offset reaccumulation protocol, which is a little more tricky, but really is just straightforward. The market actually runs the range. Now, with the standard reaccumulation protocol, the market maintains the range. With the offset reaccumulation protocol, the market runs the range. Okay, and usually what you get there is you get a flashing SMT divergence. Ooh, I just showed you something here. Cool, right? You learn more. Now, what you can do here, and the problem is a lot of you guys, for the standard reaccumulation protocol, it's really straightforward, right? You already know this, you see expansion, you wait for retracement, you buy, aim for target during liquidity, straightforward, that's what you're looking for. Now, with the offset reaccumulation protocol, the market actually runs low of the range. And what a lot of traders fall a trap into is they go in expecting this kind of delivery here, and the market just falls short of that. And then they think, maybe they're wrong in their buys. All along, the market was just straight down into a 4-hour or 1-hour discount to see expansion from. Again, what gives context into this as a manipulation is your daily directional premise. And what you can use as a confirmation that this was simply a run on stop is comparing the run lower to a correlated asset. So if this is euro dollar and euro dollar is running lower into a 4-hour or 1-hour discount, is GBP US dollar running lower or is dollar running higher? Because you're all correlated assets, right? So if euro dollar is running lower, we preferably want to see dollar running higher, which will mean that probably the run lower on euro dollar is a shift in structure and not a run on stops. But if euro is running lower into a 4-hour or 1-hour discount and dollar is failing to run higher, then this is simply a play on sell side liquidity, aka the market is just running stops into a level of discount where it will allow for reaccumulation and then continue the version of autoflow. Now, you have three options with this entry. You could either buy, once you confirm that divergence, you could either buy under this outlook here, which I believe is a little bit scary for a lot of you guys, and obviously you're going to have to grow into this. Or you could wait for, usually I wait for a 5-minute displacement. So you could wait for a 5-minute displacement to create an inefficiency or bullish order block, and then you buy the retracement into that inefficiency or bullish order block on either a 5-minute time frame or a 15-minute time frame. Again, nothing lower than a 5-minute time frame, on either a 5-minute time frame or a 15-minute time frame with stops below this low here, and you aim for your usual target. Or you could still wait for the market to get into the breaker block, and once you see the market displace through the breaker block with a fair value gap, you buy the retracement into the breaker block with your stops below the breaker block. And that's how you have 3 entries with your offset reaccumulation model. So with your standard reaccumulation model, you buy your standard retracement down into your 618 to 786 Fibonacci level. Again, the reason why I have this level on my Fibonacci, you can use this for your Fibonacci. When you're looking to be a buyer or seller, usually anything above the mean of a range is what we'll call premium. Anything below is what we'll call discount. But if you want to refine the range even more, you can use your 786 to 618 Fibonacci retracement level. And then what you're looking for is you're looking for PD arrays inside the range. So if you're looking to be a seller, you're looking for premium arrays inside your 786 to 618 Fibonacci level. If you're looking to be a buyer, you're looking for discount arrays inside your 786 to 618 Fibonacci level. And that's where you buy from. Now, again, I don't need them because I already know how to eyeball premium or discount arrays. So again, in my opinion, it's not really necessary. I don't really use Fibonacci retracement levels like that. I more of use the extension levels, but you can use this as a guide until you start to trust your eyes with your model. You can use this short term. All right, so I think let me just get a sip of coffee because I'm already, and we're almost getting to an hour with the model. I was thinking it was gonna be like 10-20 minutes, and it's almost an hour with the model. That's insane. Okay, so let's continue from where I left off. In the process of delivering to our daily terminals, aka our premium, the market will do so through a standard reaccumulation where you're just retracing down into a level of inefficiency in form of a order block or fair value gap and continue the program, or the market will actually run old lows in a bullish program and then continue to run higher. Now here's the key. If you trust your daily program, whenever we run a short-term low, you don't view that as a breaking structure. You look for the market to shift, and here's the key here. The market will see the most explosive displacement in direction of bullishness after running sell stops. I'm going to repeat myself one more time so you fully grasp what I'm saying. Price will see the most explosive displacement bullish in direction of a daily bullishness after a run on sell stops at discount. This has to happen at discount. Again, the key thing here for either of the protocol is the lower time frame program, meaning once you've identified your daily program, in this example it is bullish, you're not doing anything until your lower time frame program aligns with your daily program, aka you want your lower time frame on both the 4-hour and 1-hour to be at the discount. Once your 4-hour, 1-hour time frame are both at discount, then you can go and hunt your setups on your 15-minute time frame within your time window, which is 7 a.m. to 10 a.m. Eastern Standard Time. And you're looking for either of these two protocols. I'm going to show you on a live setting, or I'm going to use the charts actually to show you. And then this week we're going to do more live setting executions with the model. And this is what you're looking for. This essentially is your model. This is your model. And you can see the time window here, 7 a.m. to 10 a.m. Eastern. That's the window of opportunity for your model, and nothing outside that. This is when you're looking to trade your model. And you're looking to trade this in the direction of daily autoflow. Now let's go into the final part of the video, and painfully we're coming towards the end of the video because I really did enjoy this video. So we're going to talk about our checklist. What are the checklists that we require for our model? Every single time we step on the charts before the window of opportunity starts for us, what are we looking to go through to remind ourselves before we execute on our model? Number one, we need to define the daily buy or sell program and identify the general liquidity. We only scout setups when the daily spoils the displace. Remember, we make money when we see displacement. If there's a lack of displacement, we don't make money. We don't make money in ranges or consolidations. We make money when both the daily 4-hour and 1-hour program is poised to see expansion. Number two, we transpose key daily or weekly levels to lower time frame charts. Okay, so we want to make sure that our key daily levels are on our intraday chart. So when you identify your daily PD areas and identify the key levels on your daily time frame, you don't remove them from your charts. A lot of times, when I say a lot of times, I mean 80% of the time, intraday expansion will form from those levels. And that's why it really is key to have your daily levels on your intraday chart. Number 3, you want to identify your H4 and H1. So when I say H4, I mean your 4R, and when I say H1, I mean your 1R. So you want to identify your H4 and H1 discount and premium arrays around key daily or weekly levels. So once you've identified your daily level, that does not mean you remove that level from your chart. You keep them on your chart, and then you go and look for lower time frame discount or premium around those key levels to even refine your levels more for your intraday trading. Okay, and then what you want to do after that is, number 4, you want to confirm that your 4R and 1R program aligns with the daily program. Now, this is really key. This is the base for execution. You don't execute until your 4R program and 1R program aligns with your daily program. And after you've done that, then number 5, you identify a lower time frame buy side liquidity and the daily buy program, and a 1-hour time frame sell side liquidity and a daily sell program. So what you're looking for is you're looking for a now this is supposed to be corrected here. You're looking for a 1-hour buy side liquidity or 15-minute buy side liquidity for a daily buy program, and then you just flip this for a daily sell program once your 4-hour and 1-hour program aligns. Okay, you want the low or high of the day to form around a daily or weekly level. Again, 80% of the time, the low or high intraday will form around key higher time frame levels. And that's why every single time you go into your charts, always leave your higher time frame levels on your lower time frame charts. They will influence the delivery on the lower time frame charts. Number 7, in the daily buy program, you're looking for price to trade below 12 a.m. Eastern Standard Time, and this is what we call the bullish accumulation phase. And in the daily sell program, you're looking for price to trade above 12 a.m. Eastern Standard Time. Now, I've talked about the daily candle, so let me just quickly do a rehash on this, and I'll go into the next slide. This is what a daily bullish candle looks like. You have your opening price, and then you have the low of that candle. The market will open from the open price, from lower, and then go back up above the open price. And that point where it went lower becomes the weak of the daily bullish candle. And then from there, it starts to expand above the open price and goes up into a short-term premium, where when it gets up into that, it starts to pull back. And that point where it starts to pull back is what creates the high of your daily bullish candle. And this is what a daily candle looks like. You have your open, low, high, close. Now, in a daily bullish candle, we expect this for a daily buy program. And then for a daily sell program, we're expecting a daily bearish candle. All right. Now, in a daily bullish candle, price will accumulate below true day open. Now, we don't use midnight GMT time for our opening price. We're using midnight New York time for our opening price. So the same way a daily bullish candle would see initial run lower below the opening price, that opening price is what we use as 12 a.m. Eastern Standard Time. So if we're looking for bullishness, we want to see price on that day run below 12 a.m. midnight time. If we have not seen price run below that time by New York, then we expect New York to do so. If we don't get that, then we don't take any trades. Irregardless if the market expands, gets our target objective, this is the protocol, this is the checklist, that's what you have to follow. All right, so for a daily bullish program, we want to see the market trade below 12 a.m. midnight New York. For a daily sell program, I want to see the market trade above 12 a.m. midnight New York, because that is what sets the initial accumulation phase for that daily range. All right, so going into the next part of the checklist, which is number 8, we like to see the high of the day, which stands for HOD, or low of the day, which stands for LOD, formed around daily or weekly levels, and we aim for the previous day's low or high as our liquidity address. Now, this is basic profit taking. Majority of the time, the market would trade above the previous day's high in a daily bullish program, or the previous day's low in a daily bearish program. And this is, quote unquote, this is what we can use as, take profit areas, as a trusted take profit areas, right? This is like basic price understanding. If markets expanded lower, obviously we need a short-term low to seek sell-side liquidity. I already showed you that here. All right, so we have a buy-side liquidity pool, a lower time frame sell-side liquidity pool. If we are buying at discount, they want to see the market seek the most premium price, which is a short-term high. If we're buying or if we're selling at premium, we want to see the market seek the most discounted price, which is sell-side liquidity pool. And that is what the previous day's high or low offers for our intraday trades. We identify standard reaccumulation protocol or offset reaccumulation protocol based on proximity to key daily or 4-hour levels. So if we have not traded down into a key 4-hour, 1-hour, or daily level, and we see the market just make a short-term low just before that, then we expect New York to be a offset reaccumulation protocol in which retail will look to long inside this old range, while we aim for the market to run sell side and trade down into that key level to buy from. Either we buy as soon as we're touching that level, or we wait for a lower time frame displacement. So what lower time frame are we looking at? We're looking at a 5-minute time frame or a 15-minute time frame. We seek a displacement in form of a fair value gap, or we identify a bullshit block and we buy from that, expecting immediate displacement. When we trade with this kind of protocol, not the standard reaccumulation phase, which is the standard protocol for New York, I'm talking about the offset reaccumulation protocol. When we're using this protocol for our trade entries, we seek speed and delivery. The delivery after run a stop is usually faster than the delivery with a standard reaccumulation, because the market has already run to seek counterparty liquidity. And what price will do a lot of times is price will seek to quickly put all the traders who are selling, they run lower here, because there's going to be a lot of traders who are selling short, they'll run below the range. As the market runs lower there, retail is induced short, and then the one who was buying inside this range just stopped out, and then the market will see an aggressive run in the direction of autoflow. So the speed of delivery with offset reaccumulation is usually faster than that of your standard reaccumulation, right? And then number 10, your pair selection. Let's talk about pair selection real quick. If you're going to trade an asset, you want to trade the pair that's showing a willingness to want to displace in direction of daily autoflow against a reference, meaning you're looking to trade a leadership. A lot of times, you guys will have the right bias with dollar. Let's use dollar for example. So let's say you're anticipating dollar to trade higher. You would have the right bias with dollar trading higher, but then you go and select a pair that's not showing any willingness to want to trade higher with dollar. And this is what messes your analysis up, because you have the right bias, you have the right sentiment, but you're just selecting the wrong pair, because the pair you're selecting is what I call the sympathetic pair or the seek pair. You don't want to select the seek pair. The seek pair is always the pair that's showing a lack of willingness to want to displace, right? So the pair showing the lack of willingness to want to displace, you're not trading that, because that's the seek pair or the sympathetic pair. You're always looking for leadership, meaning if dollar is expanding higher, the pair you're trading, if it's positively correlated with dollar, should be expanding higher, or if it is negatively correlated with dollar, should be expanding lower. Number 11, you want to identify market protraction at New York. Now, the same way I just taught you with your daily candle, where from the open price, the market will see an initial false, quote unquote, false run lower, which induces early retail to sell short, and then institutions go and then buy against retail sentiment. You want to see the same thing for New York. So meaning, when I say you're looking for market protraction at New York open, once New York starts, which is 7 a.m., and ends, which is 10 a.m., if you're looking for bullishness, you're looking for the market to do this. The price at which that session opened is what we'll call the opening price for New York. If you want to be a buyer, you want to be buying anywhere below the opening price. Or you want to see the market trade below the opening price for New York. Again, you don't necessarily need to buy below the opening price. You just need to see that the market has traded below the opening price. Now, if you can buy below the opening price, that is preferable. That's what we prefer. That's what we want. Now, sometimes you might not get to buy below the opening price, but you want to see the market has done that. Say where you want to see the market trade below 12 a.m. midnight New York in a daily bullish autoflow or a daily bullish program. You want to see the same thing happen for New York. So you want to see the market trade below 7 a.m. Eastern Standard Time. So there are 2 times in the daily program you want to see the market trade below. You want to see the market trade below 12 a.m. Eastern Standard Time and 7 a.m. Eastern Standard Time. And these are your checklist criteria for your model. Number 12, you're identifying a 15-minute or 1 hour high or low for take profit objective. I've already talked about this before. And number 13, which is the last one, you want to place your stop 2 PD arrays above or below your 5-minute or 15-minute PD array selected. So if you're buying at a 5-minute fair value gap, if there's a bullish order block below the fair value gap, then you want to place your stops not just below the fair value gap you're buying from, but also below the bullish order block, because the market could trade through the fair value gap and trade into your order block and still be valid. Or let's say if you're buying a 5-minute CB or BISI, not CB, if you're buying a 5-minute BISI and then you have the fair value gap below the BISI, then you want to place your stops below the fair value gap. Okay, because the market can trade through the BISI, trade into the fair value gap and still be valid. So a general rule of thumb, now stops is not a fixed protocol. Okay, it's something that you, depending on that current market profile, you utilize on. And I'll do more videos on stops, and I think on the next one, right? But a general rule of thumb is you want to place your stop 2 PD arrays above or below the PD array selected for your executions. And we are almost done with the model, and now let's go and look at some actual examples on price. Now, I'm sure you guys are probably thinking to yourself, well, this model is complicated. It's too much. There's so many checklists I need to go through. There's this I need to do, and there's that I need to do. It's not. I'm going to show you how quickly you can get all of this. Now, obviously, it's easy for me because I've been doing this for years. And the thing is, you just need a few months to get acclimatized with this model, and you're good to go. So once you get accustomed with the model, you don't necessarily need to go through long checklists. You just know the key things you're looking for, and once you open the charts, either they're there or they're not, and you're good to go. All right, so now we're gonna use GBP US dollar from last week's price action to show examples with our model. All right, so we're gonna go and look for cable. By the way, GBP US dollar is called cable. Sometimes I'll write on my tweet, I'll write like cable should do this, and people still ask me questions like, what's cable? Cable is pound dollar. This is what we'll call cable. Euro dollar is what we'll call fiber. US a CAD is what we'll call loonie. Okay, I don't know why they call them those names, but I just know that's the name to call them. All right, so what we're gonna do here with pound, let me actually remove Tuesday's daily range. We're gonna use a replay tool to simulate, like if it's not simulating real time trading because there's no money involved, we're gonna use a replay tool to kind of like pretend we're trading live settings. All right, so now let's do the analysis here. Let's identify our key higher time frame levels and then define our program. All right, so let me go to a forex.com and see if I can identify that there. So I'm gonna go back and use the replay tool here. Now, if you look to your left relative to this weekly range, I'm going all the way out to a weekly time frame. If you look to your left, you can see very closely that we have a weekly volume imbalance here. So if you look at this gap between these two candles, that's an actual market gap there. All right, the algo will remember that in the future, even though that's a long time. This formed around April 22nd, over a year ago. The algo still will remember these levels. So we have this weekly inefficiency here, and the premium high of that weekly gap starts at the close of this candle, which is 1.31129. So we're going to use 1.31129 as the premium high of our inefficiency. And usually what I like to do is I like to make weekly levels red, a very deep dark red. Weekly monthly levels, I like to make them that color scheme. And then the discount low of our weekly inefficiency starts at the opening price of this candle, which is 1.30950. Okay, so 1.30950, that's the discount low there, and that's our premium. And if we trade through this level here, then we have to contend with the rejection block and then this small little fair value gap. So if you look at the slow of this candle, high of this candle, I know we have a volume balance here. We have a small little fair value gap there that we still have to contend with. So we're not really going to concern ourselves with these levels here because you're still far away from this level. Until we trade through this level, we really don't need to have all these levels in our charts. All right, so we're done with that on the weekly time frame. Now let's go into, can we identify anything else on the weekly time frame? The only thing we can see is this weekly bullshit block here. So we're going to outline this weekly bullshit block as our discount. So we have weekly bullshit block as our discount, and then we go to our daily time frame. And this is what we'll call the top-down analysis. Right, so we're going from a weekly time frame down to a daily time frame. And what we can identify here, again, let's just zoom on this range. You can see here we have a daily discount. Okay, and the daily discount is this daily bullish fair value gap. I like to use purple for my daily levels just to differentiate both. Now, what we have with this daily discount is we have the discount low of the inefficiency, the premium high of the inefficiency, and then if we use our Fibonacci from high to low here, we have the 50%, which is the consequent encroachment of our inefficiency or discount array, and we're done. Now the question is, let's identify what the program is. We have traded up, we've seen serious expansion up into a weekly premium. It makes sense to expect some kind of logical distribution lower. Now, if we're going to distribute from here, where is a discount that we can aim for? We can aim for this fair value gap here. We can also aim for this fair value gap here. So we have two inefficiencies lower to aim for. Now, I don't want to add those levels here because it'll just clutter the charts. So I'm going to leave them until we trade below this discount. And our key here is, if we're looking for weakness, aka we're looking for distribution after all of this expansion, we don't want to see the market trade above this as a premium. Now, why? Because if we trade above this weekly level as a premium, the next premium for us to trade up into and see any bearish retracement from is all the way up here. If we go back to a weekly time frame, you can see the next premium is here. This weekly fair value gap. And that is, how many pips is that from here? That's around, if we measure the pips, that's around 100 plus pips. 100 plus pips to get to the next level of premium and see bearish distribution from. So we know that if the market loses this level on a daily time frame, the lower time frame is going to be in the buy program, because it has to get all the way up here for it to then retrace or see a little bit of a consolidation. So we've created protocols for our daily buys, right? So our daily buys is a bearish retracement until we get into a discount, and that discount can be either this one, or this weekly discount before we see a resumption in the buy program. Now let's go on the lower time frame. We've already identified our key daily levels. And what you can see here is I'm leaving the key weekly and daily levels here. I'm not doing anything to it. All right, so the lower time frame, we're going to the 1 hour time frame, and I'm not going to go through and look at the checklist one by one because I already know them. All right, so I'm just going to run through each and every one of them. Okay, so and what I'm looking for is I'm looking for the time window, which is 7 a.m. to 10 a.m. Eastern for my trade. So I'm not concerned really with what price is doing until a time window of opportunity, which is here. And also what the market wants to do. So far, I'm bearish as long as we don't lose this level. All right, so now this is what the market does leading up into our time frame. Okay, and start our time frame. Now, the daily program which we're anticipating is a bearish program. That's what we're anticipating. We are at a key weekly level here, but the lower time frame program is a buy program. Okay, the lower time frame program is not a sell program yet because we're not seeing bearish delivering price. We're still seeing consolidation and then a run higher. Now I could go a little bit more and say, well, this is the Monday's consolidation and this is your jitter swing and we should see bearishness in price, but I'm not really interested in this. So again, we're not really going to execute on this because we've not confirmed yet that the daily program is bearish. Again, what we're looking for is we're anticipating daily program to be bearish. I want to see the lower time frame align with that program. So far, it's not aligned with that program yet because I've not seen the market show any willingness on a displace lower. So we're not really interested until we spot a willingness and price on a displace lower. But again, remember we're still at a key weekly premium. And now we've seen the market show willingness on the displace lower into our time window from that key weekly level. And what can we identify on the 1 hour time frame? What's the 1 hour time frame program? Here. It's a sell program now because we've taken out a short-term low from a higher time frame inefficiency after running out buy stop. So what we wanted to see here, which is why we're not buying here. Now, if the market was already bearish on the lower time frame, as we're running up here, we're selling into that run higher. But because we're anticipating a reversal and we're not sure that the lower time frame autoflow is in alignment with our, again, it's not confirmed yet, it's just anticipated. With our anticipated bearish delivery, we're not selling up here. We're waiting for confirmatory displacement. This is what I call institutional sponsorship. When you see lower time frame displaced like this from higher time frame levels, that's what I call institutional sponsorship. Now, on the 1 hour time frame, we can see that we've seen bearishness in price, and obviously in the 4 hour time frame, we can see there's bearishness in price. So now we go into a 15-minute time frame, and we're looking for levels where we can identify areas to sell from. Now here you can see inside this, as soon as we shift structure lower, below this look here, we have a premium. That's a fair value gap. Remember what I talked about? The only things you ever need is either fair value gap, order block, breaker block. That's all. You don't need anything else. Okay, so now if we have a fair value gap here, does it come out at a premium? We have this week here that runs liquidity. Because this week runs liquidity, we don't use this to measure our range. Instead, our range measurement starts from this level here. So our range measurement starts from here to here, not from this one, because this is a run on stop. This is more like a gap on liquidity. All right, so if we measure our range from all the way from the high all the way down to the low, you can see it goes above our equilibrium, which is premium. Again, anything above equilibrium, that's premium. So we have a 15-minute inefficiency. Now watch, it's not just only a 15-minute inefficiency. Also, that's the discount low of that weekly level there. So we can sell short that inefficiency because it's at premium. Aiming for, again, what did I talk about? Previous day's low is easy run on liquidity. At the same time, we can also see we have a short-term low here, which clear the market could reach for. So we could aim for below this low here and then the previous day's low. And where do we place our stops in this example? We recently had a run on buy stops on this one here and on this short-term high here. So because we had a run on buy stop here, anyone who was buying here, they are now trapped. So we don't want to see the market run above the eye of this range. So our stop goes above here. So we can use this. Again, our stop is above the fair value gap and also above the bearish auto block and also above the short-term high. So that is two PD areas above this one here. What are the PD areas? Auto block and a rejection block, right? Again, a rejection block is also a PD area too. So auto block, rejection block, our stop goes above that, and we're aiming for previous day's low. Okay, we're aiming for previous day's low, and the market offers us that. The moment we see the split, again, I want to talk about trade management on the next video, because this model, or this video, is just part one, which discusses the model itself. Part two talks about management and everything, like the other boring part of trading. And you can tell the market delivers, and eventually, I think around on the close, it gets down into, gets down into our target objective. Now let's get rid of this and let's see what happens on day 2. All right, so this is Tuesday, by the way. Last week Tuesday on pound, that's what we saw. And now going into Wednesday, we've seen the market close below 50% of the inefficiency. Now that means that there's a very strong possibility that we could trade into this as a target term liquidity there. Okay, so now you can see how it's not once you have a bias on the daily time frame, it just ends there, and that's just it. That's just your bias. Every single day, you have to constantly confirm that the market is showing a willingness to want to get down there. If the market is not showing a willingness to want to trade in sync with your daily program or your anticipated daily program, then again, I've mentioned before, either the market is setting up manipulation or the market, your bias is just wrong, just wrong with price. The delivery program for Tuesday, which is this one here, this entry here, is our standard reaccumulation program. Okay, standard reaccumulation program here, whereby we're trading a fair value gap, standard reaccumulation at premium, and we're selling short there. Now again, with the next day's trading, we're not really concerned with what price is doing. We have our key levels here, which is this daily inefficiency, and then we have this daily inefficiency also here, and we have the premium high of that daily inefficiency, discount low, and consequent encroachment. We're going to identify consequent encroachment here. Then we'll do the same thing. Again, we're not really interested in what the market does until our time window of opportunity. And now our time window of opportunity starts here. From here until here is what we're concerned with, looking for, or hunting our model. So let me go back and start from the time. All right, so you can see here, heading into our session start, we've already seen displacement lower. One thing I also failed to confirm here, and which again I did not really bother with, is the run above the midnight opening price and session opening price. I'm not going to do them in the examples here because this video is already 1 hour, 18 minutes long. All right, so I don't want this video to be too long. So I want you to go and do this yourself. Just go on your chart, look for 12 a.m. midnight New York, 7 a.m. midnight morning New York, and draw them out, and you see how the market runs against those levels before expanding in the direction of autoflow. And here, really, I'm not going to trade a day like this. I'll talk about this on video too. So when London is overextended, so when I mean overextended, I mean when London has expanded in the direction of our buys by hundreds of pips, usually it's done its daily range for the day, and New York session is low probability. So I'll teach you when to filter out trading sessions like this. Okay, there are very specific conditions for when not to trade during New York, even though your daily bias is correct. Like maybe if we see a lack of symmetry during London session, or during like FOMC, NFP, or when London sessions are overextended, during periods like this, we don't trade New York session because that lowers the probability of continuation. But now let's just see how price delivers for New York session. All right, so we see bearishness and we see more bearishness in price. But again, does it really offer anything significant? Let's look at the range from the open price to the end of New York session, about 26 pips. And this is why I don't trade New York after I see overextension during London session. I'm going to show you more examples on video too, but this is already a long one. Already is a long video. All right, so I'm going to remove all of this and let's see how Wednesday, this is Wednesday by the way, let's see how Wednesday's candle closed and we can continue to confirm that. All right, so now you can see on the Wednesday, we traded through this level here. We have this small little fair value gap. Let's identify the small little fair value gap here. Now, it's very clear that the market is trading sync with our bias, right? And the bias is looking for a bearish short-term retracement from this high time frame level. Now, what I want to draw your attention to is look at how the market forms expansion around these key higher time frame levels. That's why they are key in terms of your price delivery. Now, we have a smaller fair value gap here. Look at how the low of this day candle forms inside the higher time frame level. And then we have a final target objective here, which is that weekly bullish order block. And now we can go into a lower time frame and continue the same profile. And this is Thursday's price action, by the way. I will identify our window of opportunity, which is this time and this time. And we fast forward to those times. Oh no, let's go back actually. All right, so now we're fast forwarding to those times, and what you can see is obviously daily program is bearish, 4-hour program is bearish, 1-hour program is bearish. This is what we like to see. All right, now here we have to wait. We're anticipating daily programs to be bearish, but in a situation like this, and this is what usually happens when the market is about to make the high or low for the week. And this is really important. I want you to write this down on your note. When the market is about to make the high or low for the week, the market usually will see a very extreme run against your intended bias into a higher time frame premium or a discount. I like to see things like this because that sets the stage for the week. We've seen a run lower, and now getting into Thursday's price action, we have everything all aligning. We have the previous day's low here, we have our weekly objective down here, we have sell-side liquidity, and what I like even more is you can see the high for the day, which actually comes during Asian session, forms around this old daily bullish fair value gap, which now becomes an inversion level. Look at the constant encroachment of that level. That has become an inversion level, and that's what we're seeing the eye for. Now, if you go back to the checklist, we want to see the higher low of the day form around key daily or weekly levels. That's what you see here. On Tuesday, that's what you see here. On Monday, that's what you see here. On last 2 weeks, Friday. Do you see how it's all repeating every single time? It's repetitive. That's why I have this checklist, and that you have to follow through. Anyways, let us continue with what we're seeing. All right, so now we have a 1-hour bearish order block. Let's trade up into this bearish order block here. Okay, so we actually have a 1-hour propulsion candle. All right, so we have bearish order block, trades up there, propulsion block. We don't necessarily need to see the market trade up into this. And then we have an old inefficiency. So I have a smaller inefficiency within, and I know my chart started to get messy a little bit. So inside, let's make this a little bit like this. So inside this daily level, we have a smaller inefficiency. Now let's go down to a lower time frame on the 15-minute time frame. So we have a 1-hour inefficiency like this, and we have a 1-hour propulsion block. So we don't necessarily need to see the market trade up into the propulsion block. when do you not want to see the market trade up into a order block? So this is a form of a bearish order block, which is what we call propulsion block, which forms after the market creates an order block and trades up into that. That's when you get a propulsion candle. Usually with propulsion candles, the market sees very extreme displacement because it's in the name, propulsion, fast delivery. Now, we don't necessarily need to see the market trade up into the propulsion candle because we have a balanced price range here. So the balanced price range should act as a stiff resistance in price and not necessarily trade up into this. Now we'll go on the lower time frame, time frame, and let's see what the market forms there. We have a lower time frame bearish order block and a fair value gap here. Now let's see the opening price for the session. This is the session opening price. And what we like to see is the market trade above the session opening price for our trade. All right, so we can go into a lower time frame here, like a 5-minute time frame. Again, our executions form around a 5 or 15-minute time frame. And what you can see here is you can see the market is consolidating around that opening price, and then you have a high here, you have a low. Actually, this is the open price. You have a high here, low here. Take your range from the high all the way down to the low. Does it trade above 50%? Yes, it does. Again, because this is going to act as a stiff resistance in price. You don't want to see the market lose that balance price range. And guess what? That balance price range on the 1 hour time frame aligns with a 5-minute sell-side imbalance buy-side efficiency. Now, what have I taught you with protocols using BISs and CBIS? Until the market runs an immediate draw on liquidity, which would be the previous day's low here, you do not want to see the market close above the consequent encroachment of that inefficiency. Again, CBIS and BISs are different from fair value gaps. They are a form of fair value gap, but they're different from regular fair value gaps. They have different set of protocols. Same way a balance price range has a different set of protocols with a fair value gap. Now, with a classic fair value gap, we can anticipate the entire range of that inefficiency getting filled and still seeing displacement. But with CBIS and BISs and balance price ranges, the protocols are similar. We don't like to see the market trade completely through the inefficiency until we run a level of immediate liquidity, which is sell-side liquidity down here. So we can trade this level here because it is at a premium with our stop. Again, where do we want our stop to be at, above at? We have a CB, number 1. We have a fair value gap, number 2. We have an order block, number 3. So 1, 2 PD areas above our PD area of execution. That's where our stop goes above. And we're aiming for sell-side liquidity down here. And what is resting down there? Not just the sell-side liquidity. We also have that target on liquidity. Again, we don't need the market to trade all the way down there to make money. We can take some portions off here, but we can leave a portion on for this target objective. And look at what the market does. Let's see what the market does, and we get the expansion. And here some partials come off here. You always take partials. I'll talk about partials on video 2. So there's actually supposed to be 2 videos. And then finally, I don't know what happens next. But again, consider model for the session. And if you took all your profits, below that low down there, that is an easy to almost 3-to-1 risk to reward. I think the market eventually drops down there during on close, which it does. I'll teach this. I'll teach profit taking using time and price on video 2. So I'm going to write this down my notes in terms of things to talk about on video 2. Video 2 is going to be a lesson on modular thinking and psychology. And on lesson 2, we're going to talk about profit taking. Okay. We're going to talk about low probability conditions that will reduce the probability of a trade and means you don't execute in those kind of conditions. We're also going to talk about stop placements. All right, so this video took me 4 hours to prepare, and around almost 2 hours to record. It's 1 hour 30 minutes right now. So 4 hours to prepare, 1 hour 30 minutes to record. So I really hope this video changes everything for you in your trading. And if you enjoyed this video, I would like for you to leave a feedback on my Twitter. You can find my Twitter in the description below. And thank you all for being a part of this video. I'll see you on video 2, and trade safe. Thank you.